Welcome, everyone. Today, we are going to explore how to use a powerful tool called the Anchored Volume Profile in RTrader Pro. By the end of this tutorial, you will understand how to set it up, read its signals, and use it to make better decisions in trading. Stick with us and you will gain some really helpful insights that could change the way you look at the charts. Imagine having the power to understand exactly where the market's biggest moves started. What if you could see the precise trading volume from a critical moment onward, giving you an edge in knowing where the most significant buying and selling occurred? That is exactly what the Anchored Volume Profile offers. Unlike traditional volume profiles that merely cover fixed time periods, the Anchored Volume Profile lets you decide where to start tracking, putting you in control of the analysis. This flexibility allows for a deeper dive into key market behaviors. This flexibility makes it easier to analyze key chart patterns, which are essential for understanding potential price movements and making informed trading decisions. Let us break these patterns down in more detail to give you a comprehensive understanding of how each can influence your trading strategy. Head and shoulders. The head and shoulders pattern is a classic reversal setup, often signaling the end of an uptrend. By anchoring the volume profile at the left shoulder, you can observe if volume is increasing or decreasing as the pattern develops. Increasing volume on the left shoulder and the head, followed by decreasing volume on the right shoulder, typically indicates a weakening trend and increases the probability of a reversal. This provides crucial clues about the strength of the trend and whether a trend reversal is likely to occur. Inverse head and shoulders. The inverse head and shoulders pattern is the opposite of the head and shoulders and signals a potential reversal from a downtrend to an uptrend. Anchoring the volume profile at the beginning of the left shoulder helps determine whether strong buying interest is present. If volume is increasing at the head and continues to rise at the right shoulder, it suggests that buyers are stepping in aggressively, supporting a potential reversal to the upside. Double tops and bottoms. The double top is a bearish reversal pattern, while the double bottom is a bullish reversal pattern. Anchor the volume profile at the start of the formation to see if significant volume supports the potential reversal. In a double top, decreasing volume on the second peak typically indicates weakening buying pressure, increasing the likelihood of a reversal. Conversely, in a double bottom, rising volume on the second trough signals increased buying interest, which confirms the reliability of the pattern and the potential for an upward reversal. Triple tops and bottoms. Triple tops and bottoms are similar to their double counterparts, but involve three peaks or troughs, indicating a prolonged battle between buyers and sellers. Anchoring the volume profile at the first peak or trough helps analyze volume consistency across the pattern. For a triple top, each successive peak should show diminishing volume, suggesting that the buyers are losing momentum. For a triple bottom, increasing volume at each trough indicates that sellers are losing control and buyers are gaining strength, making a reversal more likely. Triangles. Anchor the volume profile at the start of the consolidation phase to observe where volume builds up, aiding in predicting breakout direction. Symmetrical triangles often indicate market indecision, with both buyers and sellers battling for control. Typically, a breakout in either direction is possible, so volume build-up during the consolidation phase helps determine the strength of the move. Asymmetrical triangles, which include ascending and descending triangles, can reveal whether buyers or sellers are gaining control. In an ascending triangle, higher lows indicate increased buying pressure, and if volume is building up near the resistance level, it suggests a potential bullish breakout. In a descending triangle, lower highs indicate increased selling pressure, and volume build-up near the support level could signal a bearish breakout. Monitoring the anchored volume profile in these scenarios helps validate the direction and strength of the breakout. Flags and pennants are continuation patterns that signal brief consolidation before the trend continues in its original direction. Anchoring the volume profile at the start of the flagpole gives insight into whether the continuation pattern is supported by volume. Ideally, volume should decline during the consolidation, phase the flag or pennant, and increase sharply once the price breaks out, confirming the strength of the continuation move. Wedges, rising and falling wedges, are powerful chart patterns that often signal impending reversals. In a rising wedge, anchoring the volume profile at the beginning helps identify diminishing volume, which signals weakening buying pressure and a potential bearish reversal. In a falling wedge, decreasing volume suggests that selling pressure is diminishing, which could lead to a bullish breakout. By analyzing volume within these wedge formations, you can determine if the pattern is likely to lead to a breakout or breakdown. Cup and handle. The cup and handle pattern is a bullish continuation setup that resembles the shape of a teacup. Anchor the volume profile at the start of the cup formation to observe how volume behaves throughout the pattern. Ideally, volume should decrease as the price forms the cup and then pick up again during the handle phase. An increase in volume during the breakout from the handle is a strong indication that the breakout is likely to succeed. Rectangles represent consolidation phases where the price moves sideways between defined support and resistance levels. Anchoring the volume profile at the beginning of the range helps identify if volume is building at the upper or lower boundaries. If volume builds up near the resistance level, it increases the chances of a bullish breakout. Conversely, if volume accumulates near the support level, it suggests that a bearish breakdown may be imminent. Monitoring these volume concentrations can provide valuable clues about the breakout direction. Ascending and descending channels. Channels are parallel lines that capture the price movement, either trending up ascending or down descending. Anchor the volume profile at the start of the channel to track whether volume supports the continuation of the trend within the channel. In ascending channels, higher volume near the lower boundary could indicate buying interest that keeps pushing the price upward. Conversely, in descending channels, higher volume near the upper boundary may indicate strong selling pressure, pushing the price downward. If volume diminishes as the price approaches either boundary, it might suggest a weakening trend and potential reversal. Understanding how volume behaves along these channel boundaries helps you spot possible breakouts or breakdowns, as well as re-entry points within the trend. Rounded tops and bottoms. Rounded tops and bottoms are long-term reversal patterns that signal a gradual change in trend direction. Anchoring at the start of the rounding pattern allows you to see if volume is gradually increasing or decreasing. In a rounded top, volume tends to decrease as the price moves higher, indicating weakening buying interest and a potential bearish reversal. In a rounded bottom, volume typically increases as the price begins to move higher, signaling a buildup of buying interest and a likely bullish reversal. Tracking volume during these patterns helps gauge the strength of the upcoming move. Understanding how volume interacts with these patterns gives you a much clearer picture of market sentiment and can enhance your trading strategy significantly. You may be wondering why the anchored volume profile matters. This tool gives you a chance to see where significant buying or selling took place after big events in the market. Let us say there is a breakout or a sudden reversal. By using the anchored volume profile, you can find out where a lot of traders decided to enter or exit their positions. This is valuable information because it tells you where key price levels are likely to be. All right, now let us set up the anchored volume profile in RTrader Pro. If you are following along, open up RTrader Pro and pick the asset or market that you are interested in. Make sure you can see the chart for that asset. Go to the top of the screen where you will find the indicator menu. Click on it, then look for the volume profile option. We want the anchored volume profile, so go ahead and select that. Once you have selected the anchored volume profile, you can click anywhere on your chart to set the starting point for the profile. Think of this as telling the chart to start counting the volume from that specific point in time. Now, after you have done this, you will notice horizontal bars appear at different price levels. These bars show the trading volume at each price. The longer the bar, the more volume there is at that price. This is where things get interesting. Understanding volume by price can significantly enhance your ability to make informed trading decisions. Pay close attention to the levels with the highest volume, as these often represent key areas of support or resistance. These levels act as pivotal points where price tends to stall or reverse, primarily because many traders have already committed to their positions there. When price approaches these high volume areas, it often reflects a collective decision point in the market. By monitoring these zones closely, you can better anticipate potential price reactions, giving you a critical edge in planning your trades and managing risk. Whether the price bounces off or breaks through these levels, knowing where the volume concentration lies can greatly improve the timing and precision of your trading strategy. Now, let us think about how to use the anchored volume profile to analyze both price and volume together. When you see high volume nodes, which are the price areas with the most trading activity, you know that these are important zones. The price is likely to react when it returns to these areas. Maybe it will bounce back up from a support level or turn down from resistance. The point is, these high volume nodes are areas that traders pay a lot of attention to. On the other hand, low volume nodes are areas with very little trading activity. The interesting thing about these low volume areas is that the price tends to move quickly through them. Since there is not much trading interest there, the price just zips through until it reaches an area with more volume. This makes these areas something to watch for possible breakouts. You may also see gaps in the volume profile. A gap just means that not much trading happened at certain price levels. Price often moves quickly through these gaps, and it will not stop until it reaches a level with more volume. This can make these areas good places to watch for potential fast moves. One of the main ways to use the anchored volume profile is for confirming breakouts. Breakouts are crucial moments in trading where the price moves beyond a key level, such as a previous high or low, and understanding the role of volume is key to determining their reliability. Let us say the price is breaking through a key level and you notice that volume is increasing. This volume increase can indicate strong interest from buyers or sellers, suggesting that the breakout is more likely to be sustained. High volume during a breakout generally confirms that the market has enough participation to carry the price beyond the previous barrier. It is always a good idea to look for high volume when you see a breakout because it adds credibility to the move. Without sufficient volume, breakouts are more likely to fail, resulting in a false breakout where the price quickly returns back below the key level. By anchoring the volume profile from a significant point, such as the beginning of a consolidation or a key support/resistance level, you can more accurately judge whether the breakout is backed by meaningful volume. Another way to use this tool is to spot reversals. Try anchoring the volume profile from a recent swing high or swing low. If the price moves toward a high volume area and starts to stall, this could mean that a reversal is coming. You can then decide whether to adjust your position or even take advantage of a new opportunity. Anchoring the volume profile at the start of a trend can help you track where most of the volume is concentrated. When you see those high volume levels, these are areas to watch as the trend continues. Maybe they will be places to re-enter a trade or places where you want to set your stop loss. For even better insights, you can combine the anchored volume profile with other tools. One of the most effective tools to use alongside the anchored volume profile is moving averages. Moving averages help confirm a trend's direction and strength. If the price is near a high volume node and crosses above or below a moving average, it is often a strong indication that the trend will continue in that direction. Another useful tool is the Relative Strength Index, or RSI. The RSI measures momentum and helps determine if an asset is overbought or oversold. When the RSI reaches extreme levels and the price is approaching a high volume area, it could indicate a potential reversal. For instance, if the RSI indicates overbought conditions and the price is nearing a high volume node, it suggests that buying interest may be weakening and a reversal could be on the horizon. Conversely, if the RSI shows oversold conditions and the price is near a high volume node, it suggests that selling may be exhausted and a bullish reversal might occur. Anchoring the volume profile in such situations provides more confidence that the market may turn. This combination of RSI and anchored volume profile can be especially powerful in identifying potential turning points with greater accuracy. Bollinger Bands can also be very helpful when paired with the anchored volume profile. Bollinger Bands show volatility in the market. When the price nears a high volume node and also hits the outer band, this could signal a reversal or continuation depending on the volume buildup. It is particularly powerful to see if price movement is supported by volume at key levels. The MACD, or Moving Average Convergence Divergence, is another indicator that complements the anchored volume profile. When the MACD line crosses above or below the signal line near a high volume node, it can provide confirmation that the trend has strong momentum. Anchoring the volume profile allows traders to pinpoint where these significant shifts are occurring, adding more weight to the MACD signal. Volume Weighted Average Price, or VWAP, is another tool to consider. VWAP provides an average price weighted by volume, helping identify if the price is above or below what most traders paid. When combined with the anchored volume profile, VWAP can help determine whether a move is supported by a significant volume, particularly after anchoring it from a key event like a breakout or reversal. Support and resistance levels become even more powerful when you use the anchored volume profile to reinforce them. When the price aligns with areas of high volume, it is more likely to either bounce or reverse at these points. If price movement aligns with strong volume areas while also confirming support or resistance from another indicator, it makes for a very compelling signal. So, when you see price moving toward a high volume area, consider it a strong potential level for support or resistance. Support and resistance levels become even more powerful when you use the anchored volume profile to reinforce them. When the price aligns with areas of high volume, it is more likely to either bounce or reverse at these points. So, when you see price moving toward a high volume area, consider it a strong potential level for support or resistance. Now let us talk about some common mistakes to avoid. One mistake traders make is forgetting about price action. The anchored volume profile is a helpful tool, but it should always be used alongside price action. Make sure you look at what the price is doing and consider the market context, whether it is trending, consolidating, or breaking out. Another mistake is anchoring from the wrong point. You want to anchor from meaningful places on the chart, like the start of a trend, a major breakout, or a reversal. Just clicking anywhere on the chart will not give you the best information. It is also easy to fall into the trap of overcomplicating your analysis. With so many indicators available, it is tempting to try to use all of them at once. For example, many traders may try to overlay moving averages, Bollinger Bands, RSI, MACD, VWAP, and multiple volume profiles all on the same chart. This can lead to conflicting signals and analysis paralysis. Instead, focus on a few key tools that complement each other well, such as combining the anchored volume profile with one or two momentum or trend indicators. Let the anchored volume profile guide you to those major levels of support and resistance, while using one additional tool to confirm the price action. Keeping things simple will help you make better, more confident decisions and prevent the confusion that comes with an overly cluttered chart. When using the anchored volume profile, you will want to adjust it for different types of markets. In a trending market, anchor the volume profile at the beginning of the trend. This helps you see where the majority of volume is happening as the trend progresses. These high volume areas can be used as potential levels for re-entering the trend or setting stop-loss orders. Typically, high volume nodes in a trending market indicate areas where there is strong support or resistance, which can be key points for making strategic decisions. In range-bound markets, it is best to anchor the volume profile at the start of the range. The high volume nodes within the range help you identify key support and resistance levels, giving you a clearer understanding of where the price might bounce or reverse. Traders often use these levels for buying at support and selling at resistance, making the high volume nodes critical in a sideways market. In more volatile markets, the anchored volume profile becomes particularly useful for identifying areas where traders are entering and exiting positions. High volume areas can act like magnets for the price, meaning that the price tends to move toward these zones. Watching how price behaves around these high volume areas can provide clues about future movement. For instance, if the price quickly moves away from a high volume area, it might indicate a strong rejection, whereas lingering around these areas might signal indecision or consolidation. To sum it all up, the anchored volume profile gives you a detailed look at where most trading volume has taken place after a specific event. By anchoring it to important moments on your chart, you can get a clearer picture of key price levels and make smarter decisions. Combine it with other indicators, keep your analysis simple, and always pay attention to how the price is moving. The more you practice, the more confident you will become in using this tool. Feel free to try this out and let us know how it works for you. We would love to hear your thoughts and questions as you start using the anchored volume profile in your trading journey. Your feedback helps us all learn together. So keep exploring, stay curious, and keep trading smart. Thanks for joining us today, and happy trading.